Hello and welcome to the KPI Institute's webinar, Must-Have Financial KPIs for Utility Companies. My name is Andrei Costa and I will be your host for today along with our presenter Alina Mirtoiu. This webinar is part of a series of free educational materials that aim to enhance the knowledge and know-how of those interested, while also creating a bridge between us as a company and you, our public. The KPI Institute is a research organization specialized in business performance. It operates research programs in 12 practice domains, each linked to a certification course ranging from strategy and KPIs to employee performance and from customer service to innovation performance. The KPI Institute continuously builds on its values of best know-how, data and facts and common sense to achieve its mission of integrating performance as a discipline through research, publications, and what interests us today, through educational programs such as this webinar. Today, 13 years after the KPI Institute was created, we can proudly say that our products have reached professionals in 5 continents and that our public comprises a worldwide community of 73,000 members online and 28,000 registered companies on smartkpis.com. Today's webinar will show you which are the must-have financial KPIs for water, gas, and electricity companies, as reported by the KPI Institute's Utilities Benchmarking Report series, and it will be delivered by Alina Mirtoiu, the Director of the Center for Performance Benchmarking. She is a certified benchmarking professional and KPI professional, and her research activity in the performance management field has yielded in the documentation of over 500 key performance indicators examples. As a research analyst, one of Alina's most significant research programs focused on developing a benchmarking study in the utilities sector for 3 major utilities: water, gas, and electricity generation, which comprises worldwide data. This presentation lasts between 30 to 45 minutes. Please feel free to ask any questions you might have during the webinar, as they will be answered at the end of the presentation in our Q&A session. Enjoy the KPI Institute's webinar, Must-Have Financial KPIs for Utility Companies. Now, I would like to invite Alina to begin her presentation.
Hello, everyone. Thank you for joining. Thank you, Andrei, for your presentation. And I'm glad to have you present at the last webinar from the Benchmarking in Utilities series. During today's webinar, we will discuss the current trends in financial performance management within the 3 utilities presented in our report series, which are water, gas, and electricity. We will closely analyze findings for each cluster of KPIs. Better said, we will look at key KPIs for each cluster, and we will focus on in-practice recommendation for each one of them. Now, through the webinar, we aim to identify the industry's performance level, as you will see in the histograms, to enable you as practitioners to activate new KPIs within your organization and to generate added value from a benchmarking initiative. Based on these aims, in 2016, the KPI Institute, through its Performance Benchmarking Center and the Utilities Labs, initiated a large-scale utilities project, and which is a secondary benchmarking initiative and contains 6 reports revealing key KPIs monitored by utilities companies worldwide, also presenting their performance results. Today, as mentioned, we will be discussing the financial KPIs for all 3 utilities covered. And for this part, we have chosen for the report, we have chosen to separate the financial metrics from the non-financial ones because financial gains surely are on top of the priorities for all for-profit companies, independent of the sector they activate in. So we believe that this is a part that companies should focus, and also that should be measured separately. Now I would like to start with presenting you the report a bit. We have analyzed several companies, for example, 63 companies from the water sector, 31 for the gas sector, and 59 for the electricity sector, in order to have a global overview and to enable our customers to choose the best benchmarking partners for their organizations. The companies were chosen in order to showcase the level of financial performance from different world regions, as geographical matters can influence to a certain extent the operations and of utilities companies. Moreover, in order to enable comparisons, this report includes companies with different structures in terms of size, number of employees, or departments. Before going more in depth with the matters of financial KPIs, I would appreciate your input and feedback as well. So please let me know by writing in the chat which KPIs do you consider as most important, which financial KPIs you consider as most important for your organization, and you would expect to see in a benchmarking study that will not be presented today. Moreover, before we start, I would like to see your opinion on the matter, and I would like to see which one of the 5 clusters we have used for our framework for financial performance management do you consider as most important. Let's take about 30 seconds to answer the poll, and then we will be discussing each one of the 5 clusters and KPIs that add value to your organization. Okay, so as I can see now, most of you voted that shareholders' profitability is one of the most important aspects. And I'm really curious to see if you will be changing your opinions once we end this webinar. But now we can go into depth and discuss each cluster. First one was assets and liabilities, and we have divided into main subclusters. One is assets, which showcase the expected financial benefits within 1 year, and liabilities, which reflect on the expected debt within 1 year. Why do we start measuring assets and liabilities? It's because they are key elements for computing several other financial KPIs, as we will see during the webinar. And first KPI is current assets. And an asset represents an economic resource of the company, a present economic resource of the company, to which it has a right or a type of access that other companies do not have. Assets are usually recorded on companies' balance sheets based on the concept of historical cost. And we have noticed that current assets is the indicator reported by most companies within the utility sector, as it's a baseline, and it measures the value of an organization's resources that will generate cash within 1 year. Current assets usually include cash and cash equivalents, accounts receivable, inventory, or various prepaid expenses. While cash is easy to value, usually accountants have to periodically reassess the value of the other assets. Now, another indicator for this subcluster is non-current assets. or um, this measures the value of an organization's resources, which are not likely to generate economic benefits within 1 year. And this is considered to be a long-term investment, where the full value of the assets will not be realized within the accounting year. Some examples of non-current assets include investments in maybe other companies, or intangible assets, intellectual property, if you may. And usually investments are classified as non-current if they are expected to not turn into unrestricted cash within the next 12 months. So property, plant, equipment, buildings, these are examples of non-current assets. Now we will move to the second subcluster of our cluster, which is liabilities. Current liabilities, the first KPI, measures the amount of debt that is due to be paid within 1 year. This can include both short-term debt or accounts payable. Basically, these are bills that are due to creditors or suppliers within a short period of time. Normally, companies cash their current assets in order to pay their current liabilities. Another type of liabilities measured is non-current liabilities, or non-current liabilities, and they measure the amount of debt that is not due to be paid within 1 year. So basically, long-term debt. Total liability measures the value of obligations an organization has towards other organization or their creditors, expected to result in an outflow of resources. Basically, they are the aggregated debt and financial obligations owned by a business to individuals or, as I said, other organizations at a specific period of time. And on the balance sheet, total liabilities and the equity must equal total assets of the company. If we consider total liabilities as standalone KPI, it's not precisely useful for organizations, but it is useful in a comparative situation. Now, for example, if you the total liabilities of an entity would provide insight into that particular entity by comparing it to total assets. As I said, total liabilities and equity must be equal to total assets. So as a standalone figure, it doesn't show much, but it is very useful when compared or when taken into consideration with some other KPIs. Second cluster was revenues and costs. This reflects on the cash flow of utilities in our case, and it means that the total amount of money being transferred into it means basically the total amount of money that are transferred into and out of a business, and its importance is given by the fact that it affects the liquidity of the company. The first KPI is, of course, revenue. This measures the total income earned within the reporting period. A company's revenue and net income should be measured separately if you're measuring this in practice, because it determines on the health of the business. For example, it is possible for the net income of your organization to grow while the revenue remains at the same level as a result of cost cutting. So in this situation, doesn't show any sustained growth of your company. So only measuring the revenue, it is not very relevant in practice. Another KPI is the net cash flow from operating activities, which measures the remaining balance after deducting operations related cash outflows from the cash inflows. It indicates on the money that a company brings in from ongoing or regular business activities, or the key activities, such as, let's say, manufacturing, or in our case, providing the utility to the customers. Comparing the cash flow with from operating activities with EBITDA can give an insight into how a company finances a short-term capital, and can examine a company's cash flow from examining a company's cash flow from operating activities separately from its two components, which is investing and financing, is not going to bring too much insight. And you would want to see, let's say, positive cash flow because of positive income from recurring operating activities. And a positive cash flow from, let's say, selling the assets is not going to be an indicator of financial health. So this has to be also measured to make sure that a positive cash flow is coming from actually selling your good or service to the customers. Next, we will be talking about working capital, which measures short-term liquidity, and it is an indicator of effective operations management. Working capital is usually computed by current assets minus current liabilities, and it indicates whether a company has enough short-term assets to cover its short-term debt. And if a company's current assets do not exceed its current liabilities, then it can indicate that it has trouble paying back its creditors in the short term. And the worst case scenario, if the working capital is bad, would be bankruptcy. So measuring this indicator is very important for all companies. Now we are moving on to operating expenditure. This measures the ongoing costs required for running the organizations. The company's expenses during regular business activities in a given period of time would be considered operating expenditure, and it generally represents a separate item to the cost of goods sold or the cost of sales. I believe that considering operating expenditure together with the net cash flow from operations can give companies a very good idea whether they are actually having profit out of their goods or their services, and can help them optimize their resources forward. Maybe invest more in one of their departments that are actually having very, very good results, and reduce their investments in some other divisions. So I believe that measuring the two of them together can bring insight on how to optimize resources further, financial resources. The third cluster considered by us was profitability, which pinpoints on the financial performance and earnings within the utility sector. The first KPI, which we consider as important, is the gross profit, which measures the company's profit from sales before deducting operating expenses, such as salaries or rent. Gross profit usually assesses a company's efficiency at using labor and supplies. And it's computed by revenue minus costs of goods sold. But this doesn't include fixed costs or costs that should be paid regardless of the level of output, such as rent, advertising, salaries for employees that are not directly involved in production, or office supplies. Another KPI, the second one, is EBITDA, which I mentioned earlier. This measures a company's financial performance before considering interest expenses on debt, tax expenses, or depreciation. And it is a very good measurement of a company's operating profitability. It is a good example of KPI for a benchmarking report, given that it really allows comparison of profitability between different companies, because it doesn't take into consideration the effects of interest payments from, let's say, different forms of financing, as it doesn't take into consideration interest payments usually, or political jurisdictions, and we're referring here to taxes, or even collections of assets by ignoring the depreciation. However, these KPIs should be used with caution, because even though, for example, a negative level here would indicate that a business has problems with profitability and with cash flow, a positive level does not necessarily mean that the business generates cash, because this is because the KPI ignores changes in working capital or in capital expenditures. Thirdly, we will talk about return on assets. And sometimes this is also referred to as return of investment. It measures the percentage of earnings generated from invested capital or assets. And this is an indicator on how profitable a company is relative to its total assets. Return on assets gives an idea on how efficient management is at using its assets to generate earnings. And it's usually calculated by dividing the annual earnings to its total assets. So it's also displayed as a percentage, as you can see in the example of the histogram. Our next cluster is financial stability. and reflects on the organization's ability to pay its short and term long obligations. The first KPI, solvency ratio, measures the ability of a company to meet its long-term debts, and it is a key metric that shows whether a company, or a utility company in our case, has the ability to meet its debts and other obligations. The solvency ratio indicates whether a company's cash flow is basically sufficient to meet its short and long-term liabilities. Now, although benchmarking allows comparison outside the industry in order to foster innovation, a company's solvency ratio should always be compared to its direct competitors or within the same industry, rather than viewed in isolation or outside the industry. This is because, for example, companies in debt-heavy industries such as utilities or pipelines can have lower solvency ratios than those in sectors such as IT or technology. Next, the net debt KPI measures the overall debt situation of a company considering its cash and cash equivalents. Net debt shows a business's overall financial situation by subtracting the total value of a company's liabilities and debts from the total value of its cash, cash equivalents, or other liquid assets. And the current ratio measures the relationship between short-term obligations such as debt and short-term assets such as cash or inventory, and it gives an indication of liquidity or the company's ability to pay its short-term obligations. It is usually used in practice to determine whether a company has the ability to pay off its current liabilities, and the calculation formula is current assets divided by current liabilities. In practice, the higher the current ratio, the more capable the company is to pay its obligations, as it has a larger proportion of asset value in comparison to the value of its liabilities. Usually, a ratio under 1 indicates that the company's liabilities are greater than its assets and suggests that the company would be unable to pay off its obligations if they came due at that particular point, while a current ratio below 1 shows that a company is not in good financial health. It doesn't necessarily mean that it would go bankrupt. However, a higher ratio, let's say over 3, doesn't necessarily indicate that the company is in the state of financial well-being. Depending on how a company's assets are allocated, a high current ratio may suggest that the company is not using its current assets efficiently or at their full potential, or it's not managing its working capital well. And our last cluster, which is stakeholders' profitability, which you said you consider the most important for your business. For this one, we will have 3 KPIs. We will start with earnings per share, and this indicates the net profit generated in one reporting period for each ordinary share outstanding, including equivalents. The net profit is usually adjusted by the dividends on preferred share when appropriate. And besides showing on stakeholders' profitability, this KPI also serves as an indicator of the company's profitability as a whole. However, it should be used together with statement analysis or other measures because, well, let's say that two companies have the same level of earnings per share, but one of them could reach this earning per share with less investment, while the other had to invest more in order to reach this level. We will surely be considering the first one as more efficient at using its capital in order to generate income, and let's say we will consider it as better. So this is why earnings per share should be also measured in comparison with some other analysis in order to make sure we have the full view of the problem. The second one is dividend yield. This one measures the proportion of annual dividends paid for each share relative to the market share price, but it doesn't include any capital gains. In practice, when companies pay high dividends, it may actually come um, to some additional costs because basically every dollar or every money company is paying in dividends to its stakeholders is money that they are not reinvesting in an effort of making capital gains. So we should take care when only measuring this and not also looking at how the company is investing back or what's the return of investment of the company. And lastly, the profit distributed as dividends measures the volume of profit distributed as a payment to its organization stakeholder. My recommendation, we have reached the final KPI, but my recommendation when choosing to benchmark all these KPIs is to compare, especially for the utilities, to compare yourself with companies that have the same profile, such as number of employees, geographical coverage, or number of customers. Because although I do encourage comparing yourselves with the best in class usually, you need to make sure the comparison is realistic. And if you are a company operating at the local market, maybe in one city or in one region of a country, you cannot compare yourself with the utility company that is operating on an entire continent or within several other countries. So in order to review our webinar today, we have learned about key KPIs for each of the 5 clusters. We have seen some in-practice recommendations for measuring each one of them. And we have seen some financial aspects on which organizations focus. Thank you very much for listening to the webinar today. And Andrei?
Thank you very much, Alina, for your presentation. And now we shall continue with the Q&A session. So if anyone has any questions, please feel free to address them now. All right, we've received the question. So, Alina, how exactly can someone measure the cost optimization effort within a company?
Cost optimization.
Yeah,
So
how could you measure that?
okay. I would go with measuring the operating expenses, because if you're focusing on, well, utilities, your the main part of your costs will be focused on operations. So I would go with measuring the operating expenses, and as I said, they should be correlated with the net cash flow from operations. In this case, you can see whether there is a real, let's say, return of investment. But this is the KPI I would focus on.
Thank you very much for your answer. Let's see if there are any more questions. All right, we've received a second question. Once again about measurement, how could you measure interdepartmental efficiency? Is there a specific KPI or any indicator someone could look at to try to measure interdepartmental efficiency
Um,
from what
well,
you know?
yes. To be fair, I think, or I would measure the return of investment of each department, especially the ones that are producing. But for example, if you have a marketing department, that can also have a return of investment, and you can measure how much, well, how much you invest and how much it it brings back. I think that's the best KPI to measure, to measure profitability for each department. And by interdepartmental, I'm not sure exactly what our listener meant, but I guess that in an organization, in a big organization, anyways, there are split costs and split return of investments, because you cannot work just you cannot say that just one department brought up the finances. So it's somehow intercorrelated. But for each department, I would go with return of investment. Yes.
I would assume the listener wanted to know if there are any KPIs that you could use to measure specific interdepartmental efficiency. Like, is there one KPI he could use or like two? But like you said, if you cannot actually measure one indicator for interdepartmentality and you just measure every department and then compare between them, I guess that would provide an answer.
Hmm. That's what I'm thinking. That if you measure them individually and then compare the results, it should give an idea on how the departments are operating within the organization, financially wise.
Alright, seeing as there seem to be no other questions, we've just received one now. What kind of insight or what information can we get when we compare our budget versus our actual expenses? What kind of useful information can we get from this?
By let's say by budget, I think we are considering here the assets, not not only cash but also assets. So what kind of insight do we get by can you
Comparing budget versus actual expenses.
um well, this would technically give an insight to whether the company has enough short-term assets or budget to cover its debt, and if it's um, if it's able to pay its debt, and also if it's, let's say, operating in a profitable manner. Because if you don't have enough money to pay your debts, then it means that your operations are not profitable, or your assets are not invested correctly or managed correctly.
All right, thank you very much for your answer. We've reached our allotted time for the Q&A session. Now, this brings us to the end of our webinar. Alina, do you have any last words for our listeners?
Thank you very much for participating. Thank you for participating actively. And I guess this was the last webinar of the benchmarking report series. But I will hope to see you soon with another series of webinars. Thank you. Have a lovely day.
Thank you once more for your presentation. The KPI Institute appreciates your interest in the webinar Must Have Financial KPIs for Utility Companies. Follow our websites and our social media channels to find out more details and to subscribe to our next webinar, Reinventing Performance Management, which will be held on the 20th of September by Aura Seria, the Chief Talent Officer at the KPI Institute. Also, if you're interested in getting a certification granted by the KPI Institute on vital areas within the performance management discipline, you can explore our scheduled courses on marketplace.kpiinstitute.org. Thank you again for your participation and have a nice day.